I'm going to explain to you all the basics of the stock market and day trading within these 10 minutes. So let's get started. What is the stock market? The stock market is essentially a place where people like you and me can buy and sell very small percentages of companies. By small, I mean very small, as in very, very, very small, like 0.0000001%. This is because companies are worth millions of dollars or even billions of dollars, and if the average person wants to be a part of it, they need to break it down into very tiny fractions. The very small percentages that you are buying or selling are called shares. Shares are just the units of ownership issued by a company. The reason why companies allow you to buy these small percentages is to raise funds. You get a small bit of ownership and they get money. The reason why people decide to buy these shares is to potentially make even more money. Let me give you an example. Let's say that company X has shares that are worth $10, and I decided I want to buy 100 shares. So in total, I purchased $1,000 worth of company X. As time goes on, company X expands and makes progress and the company increases in value. So now my shares are worth $13. I now decide to sell and my $1,000 turned into $1,300 and I made $300 profit. This is the main idea of buying and selling stocks. Now let's take a look at the different ways that people buy and sell these shares. Trading versus investing. Trading stocks is buying and selling shares for short-term returns, and investing is more focused on long-term returns. If I were investing in company X, I would hold my shares for months or even years. I'd be focused on performance of the company, their revenue, leadership, and future plans. This is called fundamental analysis. If I were trading company X, I would hold my shares for weeks down to minutes. I'd be focused on patterns and trends in the price of my shares. This is called technical analysis. Both trading and investing can use a combination of fundamental and technical analysis, but in general, trading is more technically focused and investing is more fundamentally focused. Now let's take a bit of a deeper look into both these concepts. If I were investing, I would do research into companies I believe will grow over time. This generally takes less effort than trading, but it comes at the cost of lower returns and introduces speculation. If I'm investing, I'm relying on the information I can find about the company and trusting it will continue to have growth in the future. But how am I supposed to know that the CEO is making good decisions or that there aren't any internal issues in the company? That's why there's speculation. Trading generally takes more effort because it involves understanding patterns in price movements and what variables need to be considered, but it removes speculation and relies on numbers and probabilities for specific movements occurring. If you have a degree in finance or business, you're probably thinking, probabilities in the stock market? That's not how it works. But let me break this down for you. Every outcome in life is simply a probability. There's a chance you're struck by lightning or of you winning the lottery. Sure, these probabilities are influenced by decisions such as whether or not you're in a thunderstorm or whether you actually buy a lottery ticket, but there's still all chances of things happening. In order for you to know these probabilities, you just need data from the past. This is why we're able to predict the chance of rain or predict that there's a solar eclipse next week. The same idea can be applied to the stock market. At any given time, there's a probability the stock will move up or down. So when these probabilities of outcomes can be predicted, then trading can be very profitable. Trading offers much higher returns than investing due to the idea of compound growth. But what is compound growth? Compounding growth. Compound growth is the idea that the initial amount of money I am trading or investing with is compounded. Using the same example as before, the $1,000 that I put into company X turned into $1,300, so I made $300 profit, or 30%. I'm now working with $1,300, so instead of 30% being $300, it's $390. Here's another example. If I start with $1,000 and make 1% gain each day for a year, I end up with over $37,000. If I do the same but only compound 1% each week, I end up with under $2,000. So the more times my initial capital is compounded, the higher my returns. This is why trading offers a higher return than investing. Which do I choose, trading or investing? Trading is more attractive than investing for a lot of people. Each trade made is another compound, whereas with investing, compounding happens less frequently. So then why aren't more people trading? This comes down to a lack of time, a lack of information, and risk. Most people work jobs and don't want to spend their free time learning strategies and patterns, and those who do want to spend the time have no idea where to start. Online, there are a lot of gurus with content and too many online courses. In reality, there isn't one best strategy or pattern, and all the info they try to sell you, you can easily find yourself. Trading is not as complex and difficult as most people are trying to make you believe. As for risk, everything in life is a risk. All you have to do is plan for that risk and suddenly it's no longer as risky. People ride motorcycles, which are dangerous, but slap a helmet on and suddenly it's not so bad. Think of this as a form of risk management. So back to the question, investing or trading. This is dependent on your own personal goals and situation, but if you're looking at it rationally and you want to minimize speculation and maximize returns, trading is the obvious choice. So now you've decided you want to trade, but what is day trading? Day trading is simply trading or buying and selling shares all within the same day. This is done to profit from price fluctuations. There are many different techniques and strategies that traders use to achieve this: swing and range trading, spread trading, momentum and trend following, the list goes on. What's common among all of these is they're all looking for patterns within the price of stocks. So now you might be wondering what traders look for when stocks are following a particular pattern. In day trading, we want to determine what causes specific price movement patterns to occur. Here are the main criteria that affect this price movement. Price is determined by supply and demand. This buying and selling is called volume. Volume or demand is the number of shares traded of a stock over a period of time. Volume affects liquidity, which is how easily you can buy or sell a stock, and it affects volatility, which is how fast or the rate that the price can move up or down. Other technical criteria that determine patterns include market cap and float. Market cap is the value of a given company. This influences the returns you get out of a trade. When companies have higher value, generally it means the company is more established and stable and there aren't as large price movements through the day. Float is the number of shares that are available to trade for the general public. This is the number of shares in circulation for buying and selling. Float influences price movement because it is in essence the supply of the stock. So if the float is lower, there is less supply and the price can move much quicker. Trading patterns. Traders will use a combination of market cap, float, and volume, as well as the stock price movement to determine whether or not a stock is following a particular pattern. Here's an example. If you know that stocks with float X, market cap Y, high volume, and have moved a specific way will usually move in a different way, then you can predict how stocks like this will move. So traders can then buy in anticipation of following that pattern. But then if it doesn't, then they would get out at a loss. This is called risk management. Here's an example. Stock X is following a pattern I'm looking for, and Stock X is currently priced at $9.80. I know that for it to still be following the pattern, it can't go below $9.65, so I'm risking 15 cents. If I'm willing to lose $60 on the trade, then I can buy 60 divided by 15 cents or 400 shares. So now if the stock reaches $9.65, I sell and lose a maximum of $60. This is the essence of risk management. Managing how much money you are willing to lose on each trade so that you are profitable over time. So now, how do emotions affect trading? When trading, there is the inevitable fact that we are human and our emotions are affected by gaining and losing money. This is a common reason as to why a lot of traders fail. Traders will have a strategy and know what they're supposed to do, but they make a few good trades and they feel overly confident and try to make money where a pattern isn't there, or they get too greedy and eventually they lose all their money. The same goes on the losing side. Instead of cutting losses, they convince themselves that they'll turn around eventually, and before you know it, their money's gone. This is why it's important to stick to a strategy, stick to a plan, and be consistent. Candlestick charts. Typically when people look at the price change of a stock, they will look at line charts. These have limitations in the amount of information they provide. They show the open price and close price for a given time frame. Candlestick charts are commonly used by traders as they show much more information and improve readings as to whether or not a stock is following a pattern. In a candlestick chart, each candle shows the open and close prices, as well as the highest and lowest price in that time frame. This allows traders to see how the price changed within the time frame, not just before and after it. Here's an example. Let's say we're looking at 3-minute intervals of stock X. On a line chart, it shows the price went from 4 to 420. It's moving up and fitting our pattern, so we want to buy. But if we look at candlestick charts, it shows that it actually went to 450 and then back down to 420, which is showing more weakness or that it's more likely to come down. Candlesticks can be very useful in determining the strength of price movements and how likely the price is to continue moving in a given direction. Orders and order types. We now know the basics of trading and how to determine patterns, but how do we actually buy and sell shares? When buying or selling shares, there are two main order types, market and limit orders. Market orders are in order to buy or sell a stock at the market's current best available price, so it will execute at whatever price it can at that time. Limit orders will execute only at the limit price or better, so a buy limit order will execute at the entered limit price or lower, and a sell limit order will execute at the limit price or higher. This ensures that you buy or sell at a specific value. Aside from market and limit orders, there are additional order types that can improve trading success and returns. Stop-loss orders are a risk management tool that automatically sells your shares once they reach a certain price. This makes sure that you get out of a trade if it's not following a pattern and limits the amount of money that you can lose. Bracket orders are a combination of a sell limit order and a stop-loss order. It is used to make your trading more automated, and it makes sure that you lock in profits if the stock is following the pattern and prevents loss if it doesn't. Partial profits. When day trading, stocks are bought and sold in anticipation of a price following a pattern. Because there's a chance that the price doesn't follow a pattern, and it's less common for stocks to follow a pattern perfectly, day traders utilize partial profits. Taking a partial profit is selling a portion of shares for profit as the stock continues to follow the pattern. This ensures profitability long term since it's less likely for the stock to follow the pattern perfectly. You take profits along the way so that if it stops following the pattern, you still make money. Overcomplication. Typically when people start trading, they're given the wrong information and overcomplicate their charts with indicators and metrics that aren't necessary. They just make things more confusing than they need to be. In reality, you just need to see the price movement and volume, and when your strategy is clear, you'll have your entry and exit prices, and that's it. It's as simple as seeing stocks that are following a pattern, knowing when to buy and sell them, and then following these points. Stockminds Simplicity. Stockminds is an application that determines what stocks are following highly profitable patterns. It tells you what the pattern is and shows you how the stock should move if it's following the pattern, and then it provides you with the probability of having a successful trade with that stock. This is essentially using AI and millions of data points to predict future outcomes. If this is still not enough, Stockminds gives you the exact prices that you should buy and sell to maximize profits. All you need to do is enter the orders, and it's that simple. If you thought this video was helpful, let me know. And if you want to see more content like this, then hit the subscribe button.